Since initiating on Minbos just over 12 months ago, their share price has been relatively flat. In our opinion, this was due to slow news flow in the second half of 2015. However, with cash now in the bank, our BFS underway, and with production that could potentially commence as early as next year, we believe it is unlikely that Minbos' share price will be at current levels in the future, given the significant underlying value that we see at their high-grade Cacata rock phosphate project in Angola. Through this review, we take a brief look back at what Minbos achieved during the past 12 months, their targets for the coming year, as well as review our valuation for the company. The second half of 2015 was slower than what we originally anticipated for Minbos. This was mainly due to the proposed merger with their joint venture partner at the Cacata project not proceeding. This proposed transaction consumed a significant amount of management's time as well as funds. It also led to Minbos' cash balance running dangerously low, which in turn put pressure on the share price as the market expected a heavily discounted placement. However, this was not to be the case, as Minbos announced a $3.4 million placement at a 150% premium to their share price. This was a significant vote of confidence in the project, as premium placements are rare at the best of times. And considering Minbos' position at the time, the new shareholder could obviously see the significant long-term valuation potential of the asset. We also note there was a 1 cent option attached to the placement, which expires before the end of the year. If this option is exercised, it would generate an additional $7 million. Once the cash was in the bank, Minbos announced the BFS for the development of the Cacata project had commenced. A key part of this study was taking bulk samples, which happened earlier this month. This is a critical stage for the development of Cacata, as the bulk samples will go a long way to confirming our belief that the project will be a DSO-style operation, meaning low capital costs, low operating costs, as well as a reduced lead time from a decision to mine to first production. So looking to the year ahead, we recently interviewed Minbos' CEO to discuss the key targets for the company during the next 12 months.
Well, the first thing we're doing is our bulk sample. And that 20 tonnes of material is on its way to South Africa at the moment. 10 tonnes will stay in South Africa and form the basis of pilot plant work for a wet scrub and screen process. 10 tonnes will go off to America for testing on a dry route. We'll make a decision at the end of the year which is the best route to maximise the potential of the deposit and accelerate production. In the meantime, we'll continue with other work like geotechnical drilling, hydrogeological work and environmental work, and we'll also look at port logistics, the best way to actually get the product onto the boat. We know where the port is, but we want to look at the best way of actually getting the product from mine to port. All of that will flow into a continuation of a bankable feasibility study. We'll use the same engineer for both processes. We're very close to appointing that engineer. I hope to do that in the middle of July. Depending on which route we choose, we could be finished that definitive study or bankable study early next year, or in the first half of next year, or it might flow on a little bit longer than that. At the same time, we'll be doing obviously infill drilling and market studies and providing sample product to customers, and that'll keep us pretty damn busy for the next 12 months.
So with a number of strong catalysts in the coming year, we have reviewed our valuation for Minbos. We have again only focused on the small yet high-grade section of the Cacata resource that we believe will only require a simple scrub and screen to produce a saleable product. The majority of our assumptions have remained largely unchanged, which resulted in an after-tax NPV for 100% of the Cacata project of US $280 million. We have applied an additional 50% discount to our valuation at this time, given a number of our assumptions require further confirmation. We will review this risk weighting at the completion of the BFS. This overall results in a current valuation per share for Minbos of 3.3 cents per share. But given the current stage of development, there is still a degree of uncertainty regarding a number of our key assumptions. We therefore examined a range of scenarios with both upside and downside potential compared to our base case. As illustrated in the graph, even on the downside scenario, there is still a significant premium to the current share price that we believe highlights the significant valuation potential of Minbos. To view our site trip to the Cacata project in Angola, a review of the phosphate market, management interviews, as well as our risk and investment analysis, please visit thesophisticatedinvestor.com.au.